How much do you read into yesterday's rally? What do you read into this ADP number today? What really matters?
The context for yesterday's rally matters a lot, which is the market was down a ton. It was down 1,800 points in 6 weeks, means it's primed to kind of catch a spark. And I think that's what happened. It made some use of that oversold condition. The fact that yields went up was significant, right? You had a relaxation of this buy bonds in a panicky way and sell stocks. So that reversal, I think, is positive. You see a lot of the internal measures of yesterday's rally pretty much check off the box and say this was a pretty important little bounce. Almost 90% of all volume and up, all that stuff.
What about the reverse of the reversal with bonds back below the 10-year?
That's the issue. So today you get these numbers from ADP, and the bond market kind of doesn't give you the green light for stocks. That's the way I would read it right now. And I think yesterday's comments by Jay Powell and the other Fed officials were not that different, but the market was ready to hear what it wanted to hear because stocks were down a lot, and they're looking for that clearance. Big question for me is a Fed rate cut, if and when it comes, going to be an inoculation against something or the medicine to treat something? That's what the market's trying to ask.
Jim, give us a little bit of a longer-term picture of what you think is really happening in the economy, in the markets, how you kind of mix it all up and what you think it means.
You know, Becky, I think fundamentally the economy is not in that bad a shape. I think we're overblowing the negative impact of the trade war. I don't think it's been that impactful yet. It'd have to go on for a long time to have big impact. Global trade flows have been flat for more than a decade, and having them continue to be flat probably isn't that big a deal. So I think we're in decent shape. What I worry about, and what Mike alludes to, is a fear freeze here, is a financial market fear freeze. And I think the bigger issue facing the markets right now, which yesterday points out to me, is about the inversion of the yield curve and having free market bond vigilantes price the 10-year so far below the funds rate, appearing as though a recessionary message is imminent. And I think that yesterday, not just Powell's comments, but other Fed members signaling, and then the reaction from the stock market is telling. I think that the Fed needs to take out the inverted curve fear more than they need to address the fundamental fallout from the trade war. And if they do that, then I think the underlying economy is going to be okay, and I think the stock market goes on to new highs.
Hey, Jim, I think it's not just a fear factor when it comes to the markets and to investors. I think maybe the bigger fear factor could be to CEOs, CFOs, people who are making decisions about how much money to be plowing back into business. We keep waiting for that capital expenditures number to pick up, and all of this uncertainty and fear factor, I think, could have an impact on the real economy eventually if that continues.
If it goes on long enough. But it's interesting, you know, you look at consumer confidence reported at the end of May, and it's at a record high. And you look at consumer confidence in China, reported in April, and it was close to its highest levels of the recovery. The trade war has been going on since July of 2018, and someone forgot to tell the consumers in China and the United States that there's a trade war. If you look at CEO confidence, it's still pretty high. The small business SBOI optimism index is close to highs, and I know they could deteriorate. And capital spending has gone flat, but it hasn't collapsed. If you look back at the 2015-16 major global manufacturing slowdown we had back then, it was much worse. We had much deeper declines in bond yields, much deeper declines in commodity prices. We had non-defense ex-air capital good orders fell 10 to 15%, where they've basically been flat so far in this cycle. I just think it's not nearly as bad yet as people think, and the bigger issue is the fear being created by an inverted curve. I could be really wrong, and it could get worse, but that's kind of where I'm at.
You're really making sense today, at least to me.
It makes a lot of sense, but the question is, if the Fed is also looking at those good consumer confidence numbers and also believes that the real economy is doing fine, do they need to see erosion in that data before they act?
They got the inflation side to consider.
Sure.
And what you said, I was thinking about that, how patently nuts it would be to wait till you're actually sick before you,
if you knew it was an
I know, but if I could choose inoculate or treat what I have, I mean, don't you wish we could get inoculated for everything and never get anything, right?
Yeah, but you're never sure if that's going to be the trick, right? It's not clinically tested.
The Fed is not
25 basis points in July.
But the Fed typically is not an inoculator. They are.
Well, they try. They think they are.
know,
and everyone keeps
not.
pointing to the one or two examples when it did work that way, which
Yeah.
is in like 95 and 98, arguably.
Well,
but the odds
when they
are,
went up
are
when they
against.
shouldn't have. I remember Greenspan went up for no reason.
We have as much inflation right now as we had when the Fed funds rate was below 1.
Yeah.
So it's not as if it's collapsed.
Right. Jim, I think there's a difference between the tariffs with China and what would happen if we actually started putting tariffs on Mexico on Monday of 5% and ratcheting them up every few weeks by another 5%. What do you think?
Yeah, I mean, eventually you could make a case that it's going to have negative impact, and I agree with that. But I think it's a long time. I think it's like leaving them on for a considerable period of time before it had a lot of impact. You know, you think of the impact of tariffs would be through the inflationary transmission mechanism that reduces purchasing power in the United States. It couldn't be a better time to have that. We've just paused inflation pressure. CPI, PPI, commodity prices have all come down. We have global disinflation as a theme that's pretty strong in the world, and even the Fed can't get its core PCE measure up to snuff. So if you're going to have an inflationary fallout from tariffs, it's probably the best time. We have a lot of disinflationary offset to that. I'm not sure that some prices will go up a lot, Becky, but the aggregate purchasing power of the consumer might stay in better tack than you think.